I don't see a recording sign now. There we go. Perfect. All right. So from here on out, at least theoretically, we're going to have this on record. And, you know, that way, if some people couldn't make it because of a bad link or for some other reason, this will be accessible to them. So let's dig right in and let's talk about real estate. So for most people, an investment in real estate, also known as their own home, is perhaps the biggest investment they're ever going to make, right? I mean, for the vast majority of people, it's going to be home, and then it's going to be car, and then it's probably going to be a savings account. Okay, I see some chats here. Are those questions?
No, it was just a sign-in sheet in case
Okay.
you missed it.
Okay. So, all right. So this is going to be the most valuable investment for most people for various reasons. I mean, you guys, I hope are going to be in the upper quartiles of the earning bracket. So maybe for you, they won't be, right? We're going to talk about why a home might be a good investment and what are some of the drawbacks. There are, of course, investments that are not just the home. So let me be clear. It's perfectly possible to invest in a rental property that you rent out to somebody else. It's perfectly possible to involve yourself in a, all right, what's going on here? Sorry, the chat thing is popping up in the middle of my screen. So it's perfectly possible to invest in commercial property. It's perfectly possible to buy a tract of land that you might plan to build a house on later, or that you might plan to sell to someone else after the land appreciates in value. It's also possible to buy something for the resources that are on it. I mean, oil companies are certainly engaged in the purchase of various places where it might be profitable to set up an oil rig. But frequently, investments in real estate that are personal are financed with a mortgage loan. And this is true for tracts of land and all of these other deals as well. Why? Because the bank wants to give you a loan, but they want to have a security interest in the property. So that if you do not pay the loan, the borrower then loses the property to the bank. And what usually happens is a foreclosure sale. You might have heard or seen some of these, or maybe even attended some of them. In a foreclosure sale, the bank sells the property that you were not able to pay off. They take the money and they apply it to the remainder of the loan. And if there is any money left, they must convey it to the borrower that defaulted. If there is still a deficit, if they're not able to sell the property for the value of the loan, it is possible that the person that took out the loan would be liable for the remainder. So what are the risks? Well, for a long time, the conventional wisdom in finance and banking was that investments in housing, at least from a bank's perspective, were without risk. And they thought for a long time that, I mean, how can people not pay their mortgages? After all, where are you going to live? And so by having this kind of perception, banks began to really treat this as a riskless investment. And remember what I told you at the beginning, there is no such thing as an investment without risk. And because they mispriced the risk in these investments, we had the 2008-2009 financial crisis, which for stocks, it took 5 years to climb out of. And for regular people, well, there are still folks that may not have recovered from what happened as a result. So the risk is, don't buy a home thinking it's going to be a riskless investment. I mean, you're correct. Property values ordinarily go up 4 to 5% per year, not adjusted for inflation, which is about 1 to 2%. But what you should remember is that while these investments do generally go up, this is not uniformly true. It's possible, for example, to buy a house in a city that later becomes Detroit. There are many, after the Detroit bankruptcy, there are many, many places, and even before, there are many, many places that were once worth a lot of money that you can't sell to anybody now. There's literally, it's worth zero because people are completely unwilling to pay for the house. Also, remember this, it's not diversified. So we're going to talk about diversification when it comes to stocks here in a minute. It just means having several different kinds of stocks. So if one of them does poorly, it doesn't tank your entire portfolio. But The same can be true for property, right? So when you have all of your money or the majority of your money in one property, in one place, in one city, in one county, in one state that might end up doing badly for whatever reason, you have nothing to balance that with. And so because it's not diversified, you have to take tremendous amount of risk in order to buy a house from that perspective. But what are some of the rewards? Well, ideally, your home value will continue to rise at that slow and steady 4 to 5% annual rate. And eventually, the value of the home will greatly exceed the mortgage loan obligation of the investor. At that point, you have the opportunity to turn around and sell the home for a large profit. There are many tax breaks that exist that encourage, these kinds of transfers, so to speak. For example, when you sell a stock at a capital gain, you usually have to pay taxes on it. That is not necessarily true with a home that you've been living in. A tremendous percentage of the money that you make over, or a tremendous amount of the profit, perhaps even all of the profit, depending on the amount, may be completely tax-free. So, if you buy a home in a good area, like if you bought a home in the Los Angeles area 30 years ago, and you've just now finished paying off your 30-year-old mortgage, you're really in great shape. And so that's why some people choose to take on the risk of home ownership uh, as opposed to not. Now, what you really want to get a home is you need to think about having a credit score. Unless you have the money that is just upfront going to entitle you to buy the home outright, most people don't. You have to actually qualify for these mortgage loans. And because there are transaction costs with respect to issuing them and foreclosing on a home, banks will not hand out these loans to just anyone. You have to have a credit score that is sufficiently high. For most people, this is a summary statistics table out of a fairly well-known financial publication on credit scores in real estate. And part of the points that this paper is trying to make is it gives you the average FICO score in each year leading up to the financial crisis, and it gives you the mean loan to value percentage. Now, you see, what happens is all of you, well, most of you probably have a credit score, right? So if you've ever had a credit card, if you've ever taken out any kind of loan, you probably have a credit score, student loans included, by the way. And so because you have a credit score, that is a number usually between 300 and 850 or 250 and 900, depending on the specified type of score, that will tell a credit card company whether you're a good risk and specifically how good of a risk you are. So in this particular case, you have a mean FICO score. What this paper tells you is most banks, they're not usually not going to give you a loan if your FICO score is below 620, right? So the higher the score is, the better. The closer to 850 or 900 you are, the better you are. The lower it is, the worse of a risk you are. And so when we look at the mean FICOs, okay, you see that overall, the people that have gotten loans over the course of time in the early and mid 2000s, their FICO score has generally risen. The number of loans had gone up, right? So this is the precursor to the financial crisis. The crisis, everybody's buying a home. And you also see the mean loan to value ratio going up, okay? And that means that they're getting, if you have a mean loan to value ratio, it means you're getting a loan that covers 81.4% of the home price. The rest of it is coming out of your pocket because usually you have to have a 10 or 20% down payment. And so as you can see, banks continue to expose themselves to more and more and more risk as they continue to allow the down payments to be lower and lower and lower. And this is for low documentation applicants, so people that didn't have all of their documents when they applied for the loans. And this is for full documentation. You can actually see that individuals with full documentation were able to secure loans even though their FICO scores were lower. And because they were able to provide full documentation, they're able to get a higher proportion of the loan. All right, at this point, let me stop and see if there are any questions.
Yeah, there's one question from Megan.
Okay, go ahead.
Does a decreasing mean FICO value also show how 2008, 2009 was going to happen?
Well, maybe. I'm not sure that the FICO value is necessarily decreasing, right? So, for example, in 2001, you have a FICO, the average FICO score is 630. But in 2006, right on the precipice of the financial crisis, you have a mean FICO score of 655. So, not necessarily, right? I'm not so sure it was the FICO scores that did people in. There were many things that came together to basically drive the economy into a tailspin.
Yeah, okay. We have another question from Sid. Why do you have tax benefits for profits made on top of mortgage loans?
So you would have to be a little more specific, whoever is asking the question. Are you saying that the banks have tax benefits for the interest that they receive from the borrowers? They don't. They don't have that kind of tax break. But if you sell your property for a capital gain, that is, you sell your property for more than you bought it for, you do have basically what is known as a homestead tax exemption. And why that is, well, I'm going to give you the cynical answer. A bunch of homeowners lobbied Congress. So,
And then we have a question from Korian.
okay.
Does increase in risk by bank mean increase in return on investment?
Yes. So, or if you have a lower FICO score, right, but you still happen to get a loan, you're still going to be stuck with a higher interest rate. So somebody with a 750 FICO score is going to pay these days probably like 4%. Whereas somebody with a FICO score of 600 might not get a loan, but if they do, they will get a 5 to 6% interest per annum. And over the course of 30 years, well, I'll let you run the calculations in an Excel spreadsheet yourself, but that's going to be hundreds of thousands of dollars more in overall cash payments.
And then we have one more question from Megan.
Mhm.
Quick difference between low documentation and full?
So I wish I was the author of this paper because it was very well published. So low documentation might mean something like, they ask for your bank records, they ask for your investment records, they asked for your pay stubs, and you didn't have them, right? Or you didn't submit them. And the bank said, okay, this person's got a really good score, so we really think these are actually in good order, so we're not going to make them submit it. Whereas full documentation means the bank asked for all of those things and the person was able to bring them back. All right. And what you see in the mean FICO scores is the willingness of banks to take a greater risk on lower score applicants, right? If you give them as much information as possible, as opposed to the low documentation. This is a problem we commonly refer to in finance as information asymmetry. The less I know about you, the more I'm going to charge you to take out a loan from me because I have to compensate myself for the risk about that which I do not know.
Oh, we actually have one more question.
Yeah, I figured they'd roll in.
Yeah, no, it's great. We love questions, so keep it coming. What would be considered a good investment if we are buying a property, since estimated rate of increase in property is 5% max, I'm assuming, and what would be a good interest from bank?
Okay, so this is one of those where I'm educating and not advising. So I'm just going to give you my opinion. And just from what I have seen, I myself have purchased a home before. I've had a mortgage. I still have a mortgage, things like that. So I'm just going to give you my opinion. Don't go on this. This is not, there are papers that talk about stuff like this. So you want to consider them. But let me give you the straight answer. First, 5% is not a cap. It is entirely possible that your home will go up 10% or 15%. Okay? It's entirely possible that you're that good and you're that skilled and you were able to pick just the right area to where prices are skyrocketing there and you're going to make money. So that's not a cap. All right. What is a good home purchase? Well, I would actually say it's very hard to know. What you're going to find is that a lot of finance people believe that the markets are quote unquote efficient, which is that the prices accurately reflect all of the information we have available about something. So really, everything is priced exactly as it should be. And every house, theoretically, is as good of a deal as any other house for the price that is being paid for it. Do I really believe that? Well, I really think you should buy a house with good schools that's relatively cheap and that is enough to house your family and yourself comfortably. Okay? So that's how I look at it. What's a good interest rate? 4% is a good interest rate. They're offering 3.5% now because of the current crisis. It's lowered the interest rates on federal debt. And so banks are able to lend from the federal government at very cheap rates, which means they're able to pass along the savings to anyone who might have the capability to take on a mortgage and buy a home. All right, let me show you one more slide about FICO score distributions, because this is also an important slide. You actually find that sort of the mean is right around 700. It's just short. So the average person, right, theoretically could afford a home. But you're also going to notice that, you know, as you, the lower incomes have lower FICO scores, and that makes sense, right? You have a lower income, you're unable to service your debt, and so you have a lower score despite your levels of wealth. Ironically enough, as you get into higher levels of wealth, there isn't necessarily as much correlation between you know, between FICO scores and your credit score. Part of the reason is older individuals, right? The wealthiest people in society are usually the eldest, and the older individuals do not need loans as much, and so there are many factors that impact the credit score that don't actually include, you know, ability to pay. They talk about things like length of, you know, age of credit, how many credit accounts do you have, how frequently do you service them, etc. And if you're really wealthy, you might never need them. So it's not necessarily a perfect correlation between wealth and credit. All right, and then I also wanted to show delinquency. Delinquencies means that you were late on at least one loan payment, and they're strong indicators of future defaults. And part of the reason I show you this now, this is coming out of the same paper, so they subdivide it between 619, right? Because remember, the cutoff is 620 for a lot of banks. And so they divide it between 619s and 620s and up, right? And if you actually look at this, you find that the 620s and up are more likely to be delinquent because banks are more careful when they lend to the people that are under 620 in credit score. But look, it doesn't take very many months for people to start defaulting. So before you go on and buy a house, okay, be darn sure that you're able to pay for it, because it can be quite a headache to be stranded with that large 30-year mortgage loan of hundreds of thousands of dollars that you may not be able to pay off immediately. That's another risk of home ownership. I saw maybe a few more chats. Have we got a few more questions?
No.
Okay, let's keep rolling. All right, so let's talk about stocks. These are a little more exciting than homes. At least to me, they are. You can buy stock in all sorts of companies. You can buy them in Microsoft, Ford, Tesla, Apple. So there are thousands and thousands of companies that trade on the American exchanges. And you have all these options. You can buy stocks, shares of stock in any of these companies, and you can say, I am a part owner of Apple or Ford or Tesla. And this allows investment in a wide variety of companies, and it allows for diversification. So, you know, some of you might think, well, Apple is a sure bet, so I'm going to put all of my money in Apple. But you aren't well diversified, and almost all companies eventually come to an end. So if you put all your money in Apple, that money might be gone. On the other hand, if you diversify and you invest in multiple stocks in different industries, you might be better off doing that. They give value to investors in two ways: capital gains, which is when your stock price rises above the price at which you purchased the stock. You buy Ford stock at $5 a share, which is approximately where it is, by the way, and you sell it at $10 a share, your capital gains is $5, okay? And then you have dividends. Dividends are basically, they're somewhat similar to interest payments. Like if you have a savings account, right? You get a quarterly interest payment from your bank or credit union. And it's the same way with dividends, right? So you get these dividend payouts. Usually they're quarterly, sometimes they're twice a year, sometimes they're just once a year from your companies. Now, I say this with kind of a grain of salt. So ironically enough, if you look at your stock the day of the dividend, right, the day that it starts to trade what is known as ex-dividend, after people have qualified for the dividend, you usually see the price of the stock be reduced by exactly the amount of the dividend. So Ford had a $1 dividend and it was trading at $5 a share before it issued the dividend. You can darn bet that it's going to trade at $4 a share afterward. And that makes sense, right? The company just gave up 20% of its assets. Why would we not discount it accordingly? And so there are a lot of people in Chicago and New York that make a tremendous amount of money by having the very fastest supercomputers to make that trade very, very quickly, to where a retail trader like me, unfortunately, I can't catch in on that trade, right? I can't, both seize the $1 dividend and then quickly sell my stock at $5. I unfortunately would have to wait until it's $4 and sell it if I want to. The risk of stocks, and particularly individual stocks, is that, well, their future value is difficult to predict. And so it is possible that it'll go directly to zero. I mean, I'm going to be honest, I have had stocks that I've bought, thankfully very small amounts in terms of dollars and cents, that have gone directly to zero. Like, I didn't think it was possible. I thought, man, this company, it has all these assets. The price is so low, it's a bargain. And I thought, this is going to be great. It's going to have a rebound. I mean, look at its history. And you know what? That stock went straight down to zero anyway. And there was no recourse. All you could do is write it off on your taxes. That's all you can do. What are the rewards? Let's see. Well, I guess my reward slide isn't coming up. What are the rewards of stocks? Well, I think they're fairly obvious. You're able to, on average, gain more than you would, let's say, holding a house, right? It's also the advantage of a stock is liquidity. At any moment, there are thousands, if not millions, of people and computers and bots that are trading this security. So if you ran into a very tough financial spell and you had to get rid of your house, that would be very hard. You would have to sell your house at a great discount because it's difficult and it takes 1 to 2 months to find a buyer. If you need money tomorrow, you can sell your stock like that. And so this kind of liquidity, in addition to the capital gains and the dividends the stock provides, gives you a tremendous amount of flexibility. All right, we're going to get to the questions in just a moment. I wanted to show you a stock. This is Ford Motor Company. As you see, it's one of our most, what would I say? It has a very long longevity. It's been on the market for a very long time. And you can see it's kind of in the middle of where it once was and where it is now. So the company is old when you only need one letter as a ticker symbol. And you can see that over time, these Ds that are here at the bottom of the chart, these are instances where the stock is issuing dividends. And so the investors who, let's say, bought in 1980 have gained tremendous amount in capital gains because the stock has gone up in price. And they've also gotten all of these dividends. So I would say they're probably happy with their investment. People who bought in 1988, maybe not as happy. All right, let's take some questions about stocks.
Okay, we have one question here.
Okay.
Say the stock we buy dips in value. It wouldn't have any effect on dividends?
It might. It might. So good that you asked this. Dividends are not something the company owes you, right? In fact, the company announces every quarter how much dividend it plans to put out, right? And so it's entirely possible for a company one day to just run into financial struggles and eliminate its dividends. And you have no legal recourse whatsoever. Dividends is something the company, at its own option, issues to stockholders. And so at any time, they can say no more dividends because our stock price is down. They can also reduce dividends. Usually companies don't pay more than 5% of the stock value in dividends. So if their stock price plummets, right, all of a sudden they're accidentally paying 10% or 15%. So they're going to reduce that dividend amount back down with respect to the share price of the security.
Okay, we have another one. What should one see while investing in stocks?
What should one what?
What should one see while investing in stocks?
Let me read it on my
Like,
other
what should
computer.
they see? Like, what should they
Should
look
they
for?
see SEE or what should they
SEE.
seek
Like,
as in?
what should they look for?
Okay, well, here's another very frustrating answer from a finance scholar, but I give you this answer because we in finance know it's very, very difficult to identify winning stocks, right? If I had the answer to what the winning stock was, I would be Warren Buffett. I wouldn't be here giving you this seminar. And even Warren Buffett has had what some people would characterize as giant mistakes. So it's difficult. It's difficult to tell you what you should seek when it comes to one stock. What I would say is, yeah, I would not even, like, you can look at their fundamentals. Like, I remember when I was a young man and I was trading, and I would look at their fundamentals. I looked at their ratios, the book to market ratio, the price earnings ratio, all these fundamental analyses. How much revenues are they bringing in? How much are they paying in taxes? What about their CEO and their corporate board? Let me just tell you the honest to goodness truth. It's very, very, very difficult to beat the people that do this professionally. The reason is they have a computer the size of this building probably, and they're doing machine learning algorithms that could look at all of those things so much quicker than you can and so much quicker than I can and analyze precisely what the price of that security should be. So if you think you can beat them, more power to you. I don't think it can be easily done, which is why later on in this video, I'm actually going to suggest that you don't invest in individual stocks unless you just really, really like something. Instead, I would suggest that you invest in exchange traded funds, which basically give you a large bundle of stocks that will be automatically diversified.
Okay. Also, we kindly ask everyone to mute their microphone, please, when they're not talking. Perfect.
Let's see.
Okay, can you read them, Martin, or?
Yeah, I got them on my other computer. So,
Perfect.
say the stock. Okay, that one we did. What are the avenues to purchase stock? Well, you can go to E-Trade or Ameritrade or Charles Schwab or Fidelity, and it's kind of like a bank account. You put your money in, and it will just sit. If you trade nothing, it'll just sit there just like in a bank account, and it will draw a small amount of interest. And then it'll give you a chance. You go to a button that says trade, right? It'll ask you to buy or to sell, and then you find the ticker symbol of the stock that you want to buy. Like in this case, Ford Motor Company, the ticker symbol is just F, right? And you would enter that. It will populate all of the fields with a price of Ford that particular trading day. And then you just need to tell it how many shares you want to buy. And it'll automatically purchase them for you within about a second. Instead of having $1,000 in, in cash, you would have, a little over 100 shares in Ford Motor Company. And then those shares will either go up or down with time. Let's see what else. Is day trading, what is a time duration of stock the buyer should keep or aim for? This is actually a good question. Well, it's hard to know, right? So with perfect foresight, right, you should buy a stock right before it's about to skyrocket, and you should sell it right about it's about to plummet, right? But who knows, right? Who knows these things? So I would give a more diplomatic answer. The more diplomatic answer is you actually receive tax benefits if you hold a stock for over a year, right? So the Congress, for whatever reason, decided to say, we are going to treat people who hold stocks over a year preferably, all right? And we're going to reduce the taxes they receive on capital gains. In fact, if you are below the 22% or the 12% tax bracket, if you're at the 10% or the 12% tax bracket, currently, before Joe Biden takes office, the tax on that is going to be zero. So it's actually possible to pay zero taxes on your capital gains. On the other hand, if you do day trading, right, if you have any capital gains, they're going to be taxed at exactly the same rate as you yourself might be taxed, and in some instances more. Also, if you trade on a brokerage that charges you a fee to trade, let's say E-Trade, they now charge nothing because of Robinhood has sort of cleared that market. But if they charge you, $10 per trade, right? You don't want to do that too often, especially if your cash is low. Is day trading a great idea for a normal user? Well, normally I'd say no, but who am I to crush your dreams? Maybe you have the right stuff. I've tried it. I did not have the right stuff. I have had much more success holding long-term investments in widely diversified exchange-traded funds. Okay, finance apps nowadays allow partial stocks to be bought. How does that work? Okay, well, basically, there are some stocks like Berkshire Hathaway that cost tremendous amounts of money. A share of Berkshire Hathaway is $250,000. One share. I think it's actually even more than that now. Warren Buffett runs Berkshire Hathaway, in case you don't know. And so he has really done well. And so he does great. But some people want to own Berkshire Hathaway, but they don't have $250,000. So brokerages have decided, you know what we're going to do? We are just going to buy and hold this share, right? And subdivide it, with proportionally to their contribution among the shareholders that want to take a slice of that share, right? So just like anything else, just like dividing $1 into 4 quarters, right? You divide one share of Berkshire Hathaway between people that wanted to pay a quarter of $250,000. So it's very simple. They shrink down your dividends and your capital gains proportional to a proportion of that share that you own. All right, that looks like all the questions for this. Now let's move on to bonds. Okay, well, I don't know if most of you guys know what a bond is. I'll tell you, it was pretty mysterious to me what this meant when I was, let's say, an undergrad. And basically, it is a loan. But instead of the company lending to you, like in the case of a real estate investment, it's you lending to the company. You can buy these loans. Usually, there are thousands and thousands of them in almost every company that you want, right? You can buy these loans in lots of 1,000. Usually, the way they're offered is one bond costs you $1,000, okay? And then you're going to make 6%. And so let's say this thing lasts for a year. Like you buy a 1-year short-term bond, and it's going to make you 6%. So that just means at the end of the year, you're going to end up with that company paying you $1,000 and $60 on top of that. That's all it means. So bonds give value to investors by providing interest on the debt. In some instances, they may rise in market value and can be sold for a gain. So you can actually have capital gains with bonds, just like you can have with stocks. The way bonds rise is that the risk associated with a company decreases. So some companies have to sell their debt cheap because they're very, very, they're precariously run. For a long time, Tesla was one of these companies, right? They would sell junk bonds. And that's all junk bonds are, bonds that are, let's say, not the most ideal investments. And, what happened over time is Tesla got to be more secure. So now it's bonds. They don't have to pay such a high interest rate to convince people to lend to them. And so that can happen in the middle of you holding a bond. So let's say you bought a really old Tesla bond, and that Tesla bond, like let's say it was 10 years. I don't even know if they offered them for 10 years, but let's say you bought one, right? And over time, Tesla became less risky. Well, all of a sudden, your bond becomes worth more. Because remember, when it was initially issued, it was discounted for the risk. But you lucked out. You bought a bond of a company that became less risky. So now the bond became more valuable. So if you bought it for $1,000, you can actually sell it for, let's say $1,100. So somewhat similar to stocks in that instance. Now, What are the risks? Well, individual bonds may perform differently from the overall market, with firms being unable to repay some or all of the debt. In a way, just like stocks, they can go to zero. Now, legally, when a company enters bankruptcy, right, they have to go in order of the people that they owe money. First, they have to pay their employees. They're the first people to have to get paid. Then they have to pay the lawyers in bankruptcy. Then they have to pay the bondholders. So you could still recover something, right? And only then the remainder goes to the stockholders. There's usually nothing left. Okay. So part of the risk is you buy a bond in a company that does poorly and goes bankrupt. So that can happen. What are the rewards? Ideally, you get all of your interest payments. The company you lent money to does not default. And then you get the value of the note. And then you can take the money that you've just earned, let's say the 6% at the end of the year, and you can buy yet another bond, okay, and make 6% off of that, and so on and so forth. All right, I see we got questions. What does it mean when bonds lose value or you lose money on a bond? Okay, so very simple demonstration. I buy $1,000 bond in Tesla. Okay, tomorrow news comes out that Tesla's caused cancer. Tesla stock plummets, and Tesla is no longer able to sell its vehicles. Therefore, Tesla is no longer able to service the debt that it owes me. Okay, now at that point, my bond has become basically worthless. I am invested in a company that cannot pay me back. That's one way to lose money. Another way that's less drastic is that instead of something like Tesla cars cause cancer, it's like Tesla autopilot isn't doing as well as we thought it would. And so all of a sudden, sales of Teslas don't drop off a cliff, but they drop a little bit. And Tesla becomes more risky. That means that the risk premium that you paid on that bond is quote unquote outdated, right? People are no longer able or no longer willing to take the risk. So even though you bought that bond for $1,000, it may be that people are now only willing to buy it from you for $900. And so you lose $100 because the risk associated with a company has gone up. All right. But bonds don't come under liquid assets since I can sell them in periodic intervals only, right? Well, so all assets have degrees of liquidity. Even for stocks, there are some stocks that are traded so infrequently that they look almost illiquid, right? Some very obscure companies, and it's kind of like, what is, we can talk about what you mean by liquid asset. What I would say is if you set the price on your bond low enough, kind of like a house, right? If you set your price on a bond low enough, okay, somebody will jump up and buy it, okay? But you are correct that you're going to pay a heavy exit price on your way out. So is it the most liquid investment? No. If you're going to do individual bonds, yeah, be prepared to hang in there for the long term. But I don't want to suggest that it's impossible to ever sell them. No, you can find another buyer for them probably on the open market through your Fidelity account or whatever it is that you use. All right. Now I wanted to talk about what the payoffs are compared to stocks. So for a stock, right, as the price, this is the price of the stock. I don't know why the people that made this chart used S as opposed to P, right? So as the price of the stock goes up, as the as the profits or the profitability of the company goes up, right? The stock value goes up, and so does your payoff. Okay, so if you're a stockholder, your payoffs are potentially infinite, right? Because potentially the stock is just going to skyrocket. You're going to do great. On the other hand, if you're a bondholder, your payments are limited. This is a zero coupon bond. We can do it. They're all the same. You can adjust the zero coupon bond to 5% coupon bond, whatever you want. Really, what it means is you can never expect to receive more than your coupon plus your principal payment, right? So you can never expect to receive more than your interest plus the original amount of the loan. So in exchange for less risk, which you get for being a bondholder, you also receive less reward. Let's see, any more? Oh, here we go. Let's see, what about government bonds? I heard that they're the safest, lowest risk. So yes, government treasuries, let's be specific, government treasuries, and the government being the United States government, are considered a risk-free asset. I wouldn't say it's entirely correct to say that anything, even the US government, is risk-free. I mean, it's entirely possible that the United States in the next 100 years fails, right? So I wouldn't say it's risk-free, but it's treated basically as risk-free because it's like, well, if the United States disbands, then we have much bigger problems than potential default. So you're exactly correct that government bonds are the safest and the lowest risk. The problem is right now for a government bond, you might get like 1%, even for like a 5 to 10 year note. Is that really worth your time? That's the question I always ask. I mean, someone is investing in these bonds, but the question I always ask is, well, 1%, that might be something you can get at your credit union. So why bother? Okay, does the company pay off the bond after a set number of years, or do you have to sell it when you want to get your money back? It's the first one. They pay it off after a set number of years, and that is specific to the particular bond you buy. Like if you bought $1,000, okay, for $1,000 bond, for 5 years later, the price drops to 900. Will the company pay back the price you bought it at? The company will pay back the price you bought it at. So if you stick with it, right, one of two things is going to happen. If the company is able to service its debt, right, it will pay it back. Okay, so then you get lucky, right? You bet better than the people who are offering $900 for it. Okay, but I strongly suspect the reason people would be offering $900 for it is because they thought there's only a 90% chance that they would pay you $1,000, right? And so they're hedging on that 10%, right? So 20% chance you're going to get your money, but there's also a chance you don't. All right, I think that's it for bonds. Let's move on to what I think is my favorite. Exchange traded funds. All right. Okay, well, these are my favorite. They're also Warren Buffett's favorite for anybody who is not a professional investor. The reason that they are so heavily favored is because an exchange, well, yeah, let me talk about what an exchange traded fund is. So they allow individuals to invest in all the same companies that individual stocks allow you to invest in. But you can do it all at once with the purchase of a single exchange traded fund. And you can buy it just like a stock. It's the same darn thing from the purchase perspective. Now, ETFs serve essentially as combinations of stock. They're bundled for you, right? And the companies that bundle them are Fidelity, Charles Schwab, Vanguard. Vanguard is perhaps the most famous, but there are many, many of these companies. In fact, I happen to believe there are actually more exchange-traded funds on the market than there are stocks, and that makes perfect sense, right? Because
thank you.
someone's got their mic on. There we go. All right. So basically, what you have to remember. What you have to remember is that with these exchange traded funds, all right, you basically come in and you get a whole bundle of stock at once. They provide almost automatic diversification. Remember the single stock risk we talked about? What if you own a security that goes to zero? Well, you pretty much don't have to worry about that if you buy an ETF because you own a small portion of tens, hundreds, and in some instances, thousands of different companies. What are the risks? Well, some ETFs can still go to zero because there are some very focused ETFs, right? So let's say you buy an ETF in the oil industry, and in 5 years, the Green New Deal passes and they say no more oil, right? So then that has that entire ETF is going to go to zero. But if you buy ETFs in things like the S&P 500, right, which is an index you see every time you turn on a financial news channel, right? You can turn on CNBC or Bloomberg or finance.yahoo.com, and the S&P 500 is right there. You can buy an ETF that perfectly mirrors the S&P 500. And if you do that, on average, you're going to make about 10% per year, not adjusted for inflation. The rewards is that ideally the investor receives capital gains from the ETF, just like they can from a stock, and in some instances a bond. And they also receive basically dividend-like distributions, where the ETF on a quarterly, biannual, or annual basis sends you what they call a distribution, but what is essentially a dividend. All right, I thought I saw a question, but I'm not too sure it's popping up now. All right, so let me take you to a chart of among my favorite ETFs. This is the SPDR S&P 500 ETF. SPDR means that it tracks the index, in this case, the S&P 500, almost perfectly, right? And this is the ticker symbol, SPY. Now, you will notice when this is using finance.yahoo.com, you'll notice something. I graphed SPY, and then I graphed, this is the S&P 500 index indicator. And you notice there's no difference. That's how close it is. That's how close it is. And if you look carefully, let's say since 1993, you made almost 300%. Even accounting for things like the financial crisis that happened in 2009, even accounting for the tech bubble in 2000, if you add up all of the dividend distributions that these individuals received and the overall performance of the top 500 companies that are publicly traded in the United States, you're going to see an upward trajectory. And that is exactly what ETFs give you. Personal experience, and this is a very common personal experience. I traded individual stocks, I've traded bonds, I've traded options. By far, these ETFs, and particularly ETFs in the S&P 500, have grossly outperformed everything that I tried to individually do. Everything. These ETFs, even though they're blind, nobody is actively managing this. All that happens is that we just invest in whatever 500 companies the powers that be designate to be part of the S&P 500. No one manages this ETF, and it outperforms the market. All right, Roberto, any questions on these? I'm not seeing any, but they're not updating very well here.
Yeah, there aren't any questions right now.
Okay, very good. So let's move on to mutual funds. What's a mutual fund? Well, a mutual fund is what used to be very popular before an exchange traded fund. And the reason it was popular is because it also gave you diversification. But usually what it did is it gave you a mutual fund manager, a professional that was going to invest in the right stuff for you, right? So unlike the blind exchange traded fund, you had a really good professional. So surely he would outperform the market, right? Actively managed funds involve professionals investing in securities they believe will have the greatest gains. And these are the people with the supercomputers and all of these other analysts running around. Mutual funds usually provide some diversification, but they're much costlier than an exchange traded fund. That SPY fund that I just showed you, there is a cost for being a part of it. It costs you 0.1% of your investment. For most mutual funds, it can cost 1%. It can cost 5% of your annual investment. And what you're going to find is, if they're not performing any better than the S&P 500, why would you give them 5%? Not of your gains. This isn't 5% of your gains. This is 5% of all of the money you put in. So that's like going to a bank and them telling you, hey, by the way, your account is going to get 5% smaller every year unless we find a way to make money. So one heck of a proposition, if you ask me. All right. So is investing in SPY like investing in the market itself? Yes, very, very similar. Very, very similar. Okay. Mutual funds. Well, what are the risks? Well, they can still go to zero, right? That's one of the risks. Um, there's been some research suggesting that the average mutual fund does not outperform the market and yet still takes your fees. So one of the risks is sort of like, well, if you take the average mutual fund and you continue to subtract the fees, you have to pay them every year, and you compare that, because, in the world of economists and finance majors, you always look for the road not taken, right? Is the road not taken better? What is the opportunity cost? And so there's a huge opportunity cost to losing a tremendous amount of your investment to fees, as compared to the opportunity to keep most of your money in an ETF and just ride it up, if presumably it goes up. All right, what are the rewards? Ideally, the professionals managing the fund will do well. Maybe they'll outperform the market. After all, some of them do. You just have to pick the right one. It's kind of like a stock, right? If you're wise enough to pick a stock that's going to outperform the market, great. More power to you. You're going to be wealthier. But if you happen to pick a mutual fund manager or a stock that does poorly, then you'll be a little disappointed. And I will tell you, it's kind of hard to know. So I, in my former life, used to work for the government of the people of the state of Florida. And so as part of our retirement programs, they made you put money in mutual funds, because investing in an exchange traded fund is not available on their website. So one of those funds, which I picked because I was forced to, the T. Rowe Price Science and Technology Fund, right? So this is a fund that charges me 1% per year to stay in it, right? Okay, well, let's compare it to the S&P 500. Well, there are little intervals where it does better, but predominantly the S&P 500 is preferred. If I had held this fund from 2015, which I didn't, I think I held it from 2016, but if I held this fund from 2016 until now, which I did, right, I actually lost out on about 25% of gains compared with the S&P 500. Somebody wrote an email, a question in an email that I should address now. It's not like the best time, but I'll do it. So somebody asked, well, should we invest in our 401ks all at once at the beginning of the year, or should we spread it out over the various months? Well, if this chart tells you anything, right, is that generally with time, stocks drift upward. And by stocks, I mean well-diversified ETFs, let's say, such as the S&P 500. In general, they drift upward. So without a perfect knowledge of the future, right, if you have the opportunity, like I am assuming you're not going to miss rent, right? I'm assuming you literally have a perfect choice, right? There's no cost to you investing up front as opposed to spreading it over the several months. Well, why in the world would you not invest at the very beginning and let it take you up for 12 months, as opposed to investing little increments over time, so that the increments that you invest toward the later end of your time are not going to have as much opportunity and time to rise in value? So yeah, I mean, it's kind of like the question, do you want to start investing when you're 20 or when you're 50? Answer is almost always when you're 20, unless you're going to do something radical and drastic, which of course I do not encourage. Okay, so now we're through with mutual funds, and let's talk about the final topic of discussion, which is options. So guys, options are really tricky.
We have 2 questions from the previous section before we get
there. Okay, good. Go ahead.
Wait, so can you read them, or should I read them to you?
I only see one. So the one I see is, does outperforming the market mean outperforming investment in ETF S&P 500? Very similar. So outperforming the market is like you graph S&P 500 and then you graph your investment, and your investment is higher than the S&P 500 graph. Now you can see that there's a 99.98 correlation between the ETF and the S&P 500 and the S&P 500. So it's almost completely synonymous. There's just that small caveat. In the case of mutual funds, if there are a huge number of closures, people selling their mutual funds, then the company is no longer able to pay back to customers since the resources got exhausted and they need to close the funds temporarily. this issue is not present for ETFs, right? I'm afraid I can't say that it's not present for small ETFs. Like there are some ETFs, the ETF I just showed you has something like $200 billion in it. Okay, that one is not going to shut down, I'm pretty sure. In order for the SPY ETF to shut down, the American economy would have to crumble to a stop. Okay, so I mean, we would be buying guns and bullets at that point to try to protect ourselves. It's if it happens, you have bigger trouble than the fact that your stock didn't do well. But there are small exchange traded funds, and particularly non-diversified traded funds, that I think face this kind of risk. I would be lying to you if I said that there aren't some very, very smart people suggesting that current ETF investment has created a bubble in exchange traded funds. Now, there are always people screaming that something is overinvested. That's been true since the beginning of the stock market back in the 19th century. But there are some people worried about it. I personally don't know what to make of it because these ETFs seem to track the indexes. And if the indexes are any indication of how the economy is doing, then what can you do better than to just track it? But there are some people talking about the dangers of these products. So like anything else that I've presented here, please be sure of the risks and rewards before you invest in something like that. All right, let's talk about options. These are really hard, guys, from several perspectives. And probably if you don't know what an option is before you came in here, this is not going to enlighten you that much, but I'm going to try. An option is a contract, basically. It is the right to purchase or sell a security at a predetermined price, which is called the strike price, at some later date. Okay? Why is that valuable? Well, these are complex instruments that should be traded with great caution, precisely because they can derive great value and also incur great liability. Why is it valuable? Because if I had prophetic visions that Apple was going to trade at $1,000 a share a month from now, right? I would buy an option at a strike price of Apple's current price, which is, I presume, 125. I haven't looked at it in a while. And if I bought that strike price and the price of Apple went up tremendously, all of a sudden my call option has become very valuable. I now own a right to purchase or sell that security at a predetermined price. The predetermined price being what it was this month, not what it was when it rose. So now I can collect the difference between those prices. So when you hear horrific stories of people losing their entire savings in a day, it usually has something to do with options. And the reason is that the scenario I've just described for you is like, it's a dream scenario. What usually happens is people buy options, all right? And options are just, they're a contract right, and they expire with time. So if you spent all of your money, they're not like a stock or an exchange traded fund, where at least it gives you the right to some property, right? If anything else, you know, you would still hold the company at the expiration of a certain deadline. When it comes to an option, once the option expires, and if it expires out of the money, you have literally lost every dime that you have invested in that option, and you've got no recourse at all. Now, what are some of the risks that are involved? If you sell someone the right to purchase stocks from you at a certain price, because remember, you can both buy options, which is a right created by someone else and transferred to you in exchange for a monetary compensation. You can also write options or sell options. So let's say you sold options on a stock that you didn't own. This is a naked call option, right? So you gave somebody the right to buy Apple from you at a price of $200 a share. And the whole time, you didn't own a single share of Apple. Then something horrible happens. Apple prices go up above 200. They go up to 1,000. They go up to 2,000. They go up to infinity. all of a sudden, you must go to the market and buy Apple at whatever price Apple is selling at. And you must convey those shares of Apple to the person that you sold the option to at a mere $200 a share. And that is a quick way to lose every dime you've ever made. And in fact, to land yourself in bankruptcy. What are the rewards? Well, ideally, you will be the person who purchased the call option of a stock that is going to skyrocket. If so, then you were able to take that position for very little down payment. And therefore, your return per dollar is going to greatly exceed any return that you would have for an individual stock or an exchange traded fund. So once again, options are by far the riskiest instrument that I have discussed with you. And they are by far the most rewarding if you win, but they also punish you greatly if you lose. And so toward the end of this, because I know a lot of people are going to want to go and invest, I want to talk a little bit about keeping your head about you, because this is the most important thing, okay? Money is not everything. If you have a bad day on the market, don't let that define your life, okay? So somebody wrote me another email, message saying, talk about Robinhood and talk about options. So I will. So this is a story of a Robinhood trader who is 20 years old, who is approximately the age of many of you that are watching this. And this is a person, if you read the story further, who got involved in some options trading. And because Robinhood has very, very lax guidelines on who can and cannot trade these highly risky securities, what happened to him is exactly what I described. So even though we don't know the details of his account exactly, basically he went out and he sold options on stocks that he did not own. And not only that, but he didn't really have very much money on the option in the account to begin with. So unfortunately, what happened was he lost big. He bet big and he lost big. And so upon seeing almost $1 million in a negative balance, he decided to end his life. What I would say is two things. If one day you do something and you see a $730,000 negative balance, for whatever reason, do not end your life. This is the United States of America. This kid was 20. You have the protections of bankruptcy. Bankruptcy means you throw up your hands and you say, I can't pay you back. So I am going to basically avoid taking any loans for the next 7 years. And by the time he was 27, he would have been free and clear of this debt in its entirety. But because people react negatively, people react very negatively to seeing downturns and they panic. This is a huge, huge cost that probably is not well estimated in the market when it comes to the kind of stress that these investments cause. So if you take nothing else away from this talk, okay, just take away this. If you find yourself in dire financial straits in the United States, do not panic for any reason. You can avail yourself to the protections of bankruptcy. And after 7 years, which you're young, life is long. After 7 years, you get pretty much a fresh start. And so first, don't get yourself into this mess if you can avoid it. And second, even if you did, it's not the end of the world with respect to any of these financial products, okay? Because there's more to life. I mean, what I want you to think about at the end of this presentation is, how do I use investment products to grow my wealth so that I can live my life? Not how do I just grow wealth for the sake of growing wealth? Because that is the quickest and the fastest way to get somewhere you do not want to be mentally or psychologically. So let's get to the concluding slide here. Finance is a rigorous and expansive discipline. I cannot even hope to have begun to cover even 1% of it in this presentation. There is a great deal of academic and professional debate on what is and is not a good investment. I had good questions in this chat. What's a good house to buy? What's a good stock to invest in? Well, people have been debating this for 50 to 100 years. So I can't summarize that debate for you. And even if I could, even if there was a consensus that a certain stock was a really good buy, then immediately you would see people buy it and its price would go up precipitously until it is no longer as good of a buy as it was, because this is a competitive market. There are risks to every investment. Even treasury notes, I strongly believe, are risky investments. Your dollar bill, holding a dollar bill in your hand is not non-risky, because inflation could go up tomorrow and the value of that dollar bill could shrink. So many more investment products exist which bear more discussion. Before putting any of your money in an investment product, you should become aware of the risks involved. Whether we've talked about these investment products or not, please be aware of the risks. And remember what happens to people. I mean, there are seasoned people that end up doing self-harm or otherwise sabotaging themselves because they get too stressed out about this stuff. And that's the number one thing I try to, keep in people's mind. Don't base your life just about money. Okay, that's very important. And finally, nothing of what I've told you here makes me your advisor. Okay, so just remember this. All right, I can give you some education and I can give you some opinions. I could never be a financial advisor for you, just on a Zoom call. All right. I mean, people are highly trained in this industry. If you believe you need financial advice, accounting advice, legal advice, tax advice, go seek it, because it's almost impossible for me to design any kind of Zoom workshop that is particularly tailored to your needs. So at the end of the day, either make sure that you know what risks you're bearing and be the captain of your own fate, or put your fate in the hands of people that you trust, that are professionals, that'll hopefully guide you to financial success. All right. Do you recommend micro investment at companies like Acorns? No. What is a hedge fund? Okay, good question. A hedge fund is a fund that uses alternative investment strategies to make money, basically. So they don't always invest in stocks, although sometimes they do. They don't always invest in options, although sometimes they do. They buy all sorts of investment products, many investment products that you and I haven't even talked about here. There are many, many hedge funds. They frequently run various pension accounts. Let me give you an example. I had a friend of mine who worked at one. And one of the things they did was they watched for oil prices in different parts of a certain region, and they owned an oil tanker. And they would send the oil tanker wherever they could buy oil the cheapest. And then they would send it where they could sell it the high. Like that was a hedge fund. That is a California-based hedge fund doing that. So it's very hard. That's part of the reason I didn't cover them. It's very hard to discuss a hedge fund because there are just so many things they do. Oh, they buy bad debt. When you default on your credit card, a hedge fund might buy the right to collect from you. And they might buy the debt for 10 cents on the dollar and then try to get 50 cents from the dollar from you. You're good to go. What is a contract fund? I'm going to tell you straight, I have no idea without looking it up. But again, there are many investment products out there, not all of which I have direct experience with. By the way, I wanted to elaborate on Acorns real quick. Why did I say no? I'll tell you why. Because the fees that they charge you are actually pretty high when you add it up. Like, I understand that they only take, let's say they round up your purchases, right, to the nearest dollar, and then they take those cents and they invest them. But even though it looks small, okay, if you look at their fees, it's like 3 or 4%. It's basically like a mutual fund fee. I mean, maybe they changed their fees since I've looked at them last, but remember that SPY fund, right? Like just exercise some self-control, I would say, right? Just take your savings, put them in that SPY fund, okay? And what they're going to charge you is going to be 0.1%. That's hard to beat that. In your opinion, is right now a good time to invest? It's difficult to make predictions, especially about the future, right? so once again, if I had the perfect answer to this, right, I would be making billions of dollars on Wall Street. Do I think it's a good time to invest? let me put it this way. If I thought about investing long term, almost any time is a good time to invest. What research has shown repeatedly is when retail investors being you and me, right? When we try to perfectly time the market, almost invariably we get it wrong. Almost invariably we get it wrong. So, like, let me put it this way. What I can say with a high degree of confidence is that if you put your money into the S&P 500 and you keep it there for a long, long, long time, and then you come back and you look at it, I can almost guarantee you that there is going to be more money in there than when you left it. So the sooner you can start, the better you're going to do. Right now, very volatile market, hard to say. In your opinion, at an age of 20 to 30, what percentage should we be saving and should be investment? And what all investments? Okay, not sure about what you mean about the last part. What all investments? Maybe you mean what should our investments be? I'm not sure. At age 20 to 30, listen, I'm going to tell you right now, I think that you should, 20% is not a low ball. I mean, especially you guys, y'all are engineers, computer scientists, y'all spend so much time at work, and I presume you don't want to be doing this until you're 75, right? So the quickest way for you guys to gain wealth, and especially wealth that grows in escalation, is to go ahead and pour that money into investments now, okay? Max out your 401ks, max out whatever plans your work offers you, max out your deferred compensation plans, because it's going to reduce your current tax burden. And, remember, some of you guys might want to be mothers and fathers at some point, okay? And even though you lead probably very, very stressful lives now, right? You want to be able to save and have the kind of savings on you to where if you needed to walk away from a job, you could. Which means that unless you've got better purposes for this money, why not put it in the stock market? Okay. A good example is comparisons of NBA players that did that and NBA players that didn't. Even after earning all of those millions of dollars, there are some professional athletes that are currently broke. And then there are professional athletes that were bench warmers. Like, they were not great players, but they happened to invest, and they're now much wealthier than the players that were well known for their skill and talent. What should be our investments like stocks, etc.? Okay, well, you should know the answer to this question because I've kind of pined on it. In my opinion, an exchange traded fund in something like the S&P 500 would be your best bet. Another fund, by the way, I want to put in here that I think is useful is a fund called VTI. And VTI is, instead of investing in the top 500 companies, you invest in literally every company that is traded on the American stock exchanges. So let me type it into the chat so that you guys have the acronym precisely. I can figure out how. Here, I'll do it from my other computer. There is another fund you look up. If you look up the correlation between VTI and the S&P 500, you're going to see very little difference. There's not much difference. And one more. I really should include this. This is a ticker symbol for another ETF. This is another S&P 500 spider. The only difference between it and SPY is that it hasn't been around longer, but it's slightly cheaper. Instead of charging you 0.1%, it charges you 0.05. It's created by Vanguard, again, a well-known, well-established financial industry giant. And Jack Bogle, who recently passed away, was a big proponent of this kind of index investing. All right. Any other questions? Well, thank you. Thank you very much. Yeah, if anyone else has any questions, feel free to send me a LinkedIn message or something. I'm going to stay on here a little bit longer with Roberto, maybe for another 3 minutes. If anyone else has any questions, just stay after. And it was great talking to you.